Let's take a look at how the performance of the markets impacted the Wespath fund returns. With that, I turn it over to my colleague Karen Manczko for the update.
Thanks, and hello everyone. The chart on the screen shows the net of all fee performance of the individual Wespath funds versus their respective market indices. The first row on the chart is our multiple asset fund, which is our flagship balanced portfolio. As a reminder, this fund has a 65% allocation to equities, 35% allocation to fixed income. The funds directly below the multiple asset fund are the four core Wespath funds that comprise it. The first column on the chart showcases the fourth quarter net of all fee performance results. And as you can see, the stock market performed positively after coming off a negative third quarter, which created positive absolute performance for the multiple asset fund and the two equity funds that comprise it. Focusing on the two equity funds, which are directly below the multiple asset fund in the chart. As I mentioned, these two funds comprise 65% of the multiple asset fund. And the primary driver to the fund's quarter and year results were stock selection by our active managers. And I'll highlight more of that in a minute, specifically the companies that impacted the performance. Also, the U.S. equity fund has an underweight to mega cap stocks, which are the largest U.S. companies. This detracted from performance as we saw strong gains from these stocks this year. On a positive note, the two equity funds' allocation to private equity contributed to the fund's performance, as we've seen strong results posted from this asset class for the quarter and year. Moving on to the two bond funds, starting with our fixed income fund. Looking at the chart, you can see that the fund modestly underperformed for the quarter, but outperformed the benchmark for the year, net of all fees. The inflation protection fund also posted strong and solid gains for the quarter and year, returning over 1% and 6% for the year. Despite the quarter and year underperformance we've experienced from the multiple asset fund and its corresponding funds, specifically the equity funds, you'll notice that if we separate out the 2-year fund performance timeframe, which essentially is the COVID market timeframe, which we normally don't highlight in our webinars, this showcases the extraordinary event of COVID and the impact it had on the markets and our strategies. Looking at this time frame closer, you'll see that the multiple asset fund and the international equity fund outperformed their benchmarks, and the U.S. equity fund performed in line. The final comment I'll make on the slide before we move on is that despite the 2021 underperformance of the multiple asset fund, you can see that the fund has outperformed its benchmark across all trailing time frames, net of all fees.
Yeah, that 2-year perspective is really helpful, Karen, because the quarter-on-quarter volatility has been fairly high, and there's been a significant change in the stocks that outperformed their benchmarks from 2020 to 2021. So putting in perspective of the COVID timeframe is really helpful context. So back to the multiple asset fund, how did it perform against its peers?
That's a great seg into the next slide. This chart showcases the multiple asset fund versus a universe of balanced funds. This universe is different from what we've shown in previous webinars. We want to measure how our balanced fund, the multiple asset fund, performed relative to other balanced portfolios and funds that are currently on the market. We're using a universe that is compiled and maintained by Investment Metrics, which is a well-known reporting provider in the investment management industry. One thing to point out is that the information is updated through the end of the year and also presented net of all fees. You can see by looking at the chart that the multiple asset performed below the median for the 1-year time horizon, but outperformed the median in the 3, 5, and 10-year time frames. For instance, in the 10-year time horizon, the multiple asset fund outperformed over 63% of other balanced funds in this comparison.
Right, thanks, Karen. So then moving on, tell us about the individual contributors or detractors for our funds in 2021.
Starting with our multiple asset fund, and I talked briefly about this on the performance slide, but you can see the primary driver of the fund's underperformance for the year was the modest underperformance of 3 of the 4 funds that comprise the multiple asset fund. And I'll talk more specifically about each of these funds in a moment.
So the S&P 500 hit new highs in 2021. How did our underweight to stocks that impact the large cap stocks impact the U.S. equity fund?
You're right, Joe. The S&P 500 hit new highs and ended the year really strong. What I find interesting is that 30% of the index's return was driven by over a handful of mega cap stocks. Why we often say that we have an underweight to large cap stocks in our U.S. equity fund it really is an underweight to mega cap stocks. And this, unfortunately, was a big detractor to the relative performance of our US equity fund. With this said, the fund's long-term strategic allocation to overweight small and mid-cap stocks and underweight mega-cap stocks detracted, as small and mid-cap stocks really could not keep pace. Another detractor to the fund was our active manager stock selection. 3 of our 6 active managers underperformed, and specifically 2 of our longest-standing investment managers, Brown Capital Management and Zevenbergen. These 2 managers have historically been our best performing managers in our US equity fund. Their investments in companies like Teladoc, Exact Science, and Proto Labs detracted from performance this year. But these companies had really strong gains in 2020. But with the market rotation, these companies fell out of favor as investors moved into names that were more pro-cyclical and they felt may benefit from an economic recovery and higher interest rates. On a positive note, the fund's allocation of private equity contributed to performance as private equity investments this year have posted some solid returns. Turning our attention to our international equity fund, similar to our US equity fund, the international equity fund's underperformance was primarily driven by stock selection of our underlying investment managers. Their investments in China, Japan, and the UK detracted. In 2021, we saw investments in China impacted by the continued government regulation and the impact that this had on technology companies. Also, the UK company Ocado, which is an online grocer, was impacted by inflation and the labor shortages that the UK is also experiencing. A final note I'll make on this slide is that the fund is underweight developed international markets in lieu of having an allocation to international private equity and private real estate. This underweight was a detractor since we saw developed markets return over 11% last year, but this was more than offset by the performance results of our international private equity allocation, which was positive.
All right, so Karen, you noted that the main driver to equity funds underperformance was stock selection. So have we seen any major changes in our managers and their holdings from our active managers?
We have seen some extraordinary years in the equity markets that have both benefited our active equity investment strategies and not benefited. I think it's worth reiterating that our investment managers invest in companies that they believe will generate outsized returns over multi-year periods. They don't invest to capture just short-term market gains. As a long-term investor, we understand and we know that investment managers or any investment manager will not always outperform. We've seen our investment managers make modest changes in their holdings while still continuing to adhere to the mandate we have hired them to manage. We believe we have skilled investment managers that will continue to find investment opportunities that have not fully appreciated by the market and will outperform over the long term.
Great, thanks for that, Karen. So let's move on now to the fixed income funds. So bonds have had improvement since their rocky start at the beginning of the year, and specifically high yield bonds have done well while treasuries and global bonds ended up in negative territory. So how did this impact the fixed income fund given our overweight to high yield and also global bonds?
You're right, it's been a challenging year for bonds with the exception of high yield and US inflation-linked bonds, which I'll talk more about when I talk about the Inflation Protection Fund. High yield bonds were up over 5.3% in 2021. With other bond asset classes in negative territory. We saw the Treasury yield curve increase from the end of 2020 till the end of 2021, which this had a negative impact on the bond market year to date, all with the exception of high yield bonds. It's also worth mentioning that the US dollar increased relative to most emerging market currencies last year, which had a negative impact on those allocations in our bond funds. With this said, the fixed income fund slightly outperformed its benchmark on a gross of fees basis last year. Focusing on the left side of this slide, the contributors, the fund's overweight allocation of high yield bonds positively contributed to the fund performance, along with issue selection by our Core Plus managers. I also want to note that our internally managed positive social purpose lending program was a contributor as we saw credit spreads tighten, which benefited this asset class. Also, the fund's allocation to alternative contributed to performance. Detractor to the fund performance included the overweight allocation to global and emerging market bonds, specifically emerging markets. We saw the dollar increase relative to those currencies in 2021, which had a negative impact on those allocations.
All right, Karen, so moving on to our final fund, the Inflation Protection Fund. This fund has posted some solid gains for the year, as you highlighted during your fund update. So please tell us more about that.
The Inflation Protection Fund has really showcased its purpose this year as being a fund that was created to protect investment portfolios against unanticipated inflation while providing a stream of income. It ended the year returning over 6%. Relative to the fund's custom benchmark, the fund's underweight to UK inflation-linked bonds contributed to the fund performance. Despite U.S. Treasury inflation-protected securities and floating rate senior loans having strong performance last year, the fund's overweight allocation to this asset class detracted from the performance since it couldn't keep pace with the fund's custom benchmark that has a 10% allocation to commodities. Speaking of commodities, commodities had quite a strong year with the increase in energy prices, and our overweight allocation to this asset class contributed to the fund performance. Finally, similar to the fixed income fund, the fund's allocation to emerging market inflation-linked bonds detracted as we saw the U.S. dollar increase relative to these currencies, which impacted this investment. As I conclude my portion of the webinar, it has been noted that there's been a market rotation that we saw in 2021. The areas of the market that did well in 2020 and before look much different than they did last year. If I think about what's contributed to the market movements and rotations, I think about how we came out of 2020 with the prospect of a vaccine and that our life was going to be back to normal. But things such as other variants of COVID, such as Delta and Omicron, has easily taken the wind out of our sails and pushed back the idea that our lives will get back to those pre-COVID times. This also caused the markets to shift, which did not work in favor of our diversifying strategies. Given the remaining uncertainty in the market, we believe it's important to maintain a well-diversified portfolio and not make drastic shifts as we move forward into 2022 and years following. We understand that there will be periods where our funds will be out of favor, and we believe that those periods will be few and far between. As we've showcased throughout the years, our long-term strategic approach to investing has served our investors well in the long term, and we will continue to maintain the strategic approach in the management of our funds.
Great, thanks for that perspective and that performance update, Karen.